Hello and welcome back to Nearsight and Farsight. I'm your host, Kevin Taylor. So a lot of clients asking, are we at the bottom? When is the bottom, and how will we know when we get there? So I think it's very hard for us to know at any given point that this is the bottom. Usually we'll recognize that we've hit the bottom when it's in our rear view mirror. But I think it's our expectation as advisors and economists to try to understand and handicap where the market is and to try to anticipate it. So right now, there's still far too many unknowns to have a very clear understanding of what the future is. But I think we do have a good understanding of things that we can tell today, like which companies are creating cash flow and in what ways do they plan to use it. So it doesn't stop us from knowing what economic elements are positive in the marketplace and what companies are going to continue to use with their free cash flow and where things are headed. So we keep being asked, are we at a bottom? When is the bottom going to be in? And our answer is going to be maybe. There are certainly some early inning identifiers that we can see that we can start building a case saying some of the worst is behind us, and that a lot of the repricing of the marketplaces already happened. So now we're going to start looking at some of the technical elements to start saying, was that the bottom? Was a couple of weeks ago the bottom? And when can we confirm and say that that bottom is in? So we'll look at a couple different things. We want to look at the trend, and we feel that the trend is pretty well established. We want to respect the continued downward trend trajectory that has taken its toll on all different equities classes and the bond market. This is represented by the red channel here on the chart. This represents the range that the market has drifted between and its upper and lower bounds on its way down. The last time the market drifted towards that lower bound and kind of bounced off of it, the S&P 500 closed at 3,666, like a very demonic number, if you ask me. And I have it on June 16th. So that's kind of been the number that we've been looking at, saying, hey, there is something that happened there. There was a clear reversal after that. And if we can continue to kind of respect that line, that might have been the bottom. And since we've drifted up slightly since then, obviously not enough to change that channel, but enough to make us think that might be the early indicator of some sort of a bottom. We're waiting on some confirmation for that level, though. In addition to the quick rejection that we saw at the 366 level, we saw that coincide with a major trend reversal in the momentum indicator as well. And the MACD on the weekly momentum indicator kind of shifted at the exact same time. So not only do we have a change in the price and a pretty quick bounce off that level, but we also saw a shift in the number of people out there buying into just the stock market generally. The other thing that kind of indicated that might have been a moment of capitulation, at least for us, is that the CPI print that had come out today didn't result in as much fear in the market. And it's a down day today, but it didn't result in as much fear as I think people had anticipated. And to me, that says that a lot of the fear and selling pressure had already been baked into the market, and that people had kind of capitulated. There was a huge sell-off between June 8th and June 16th that might have been a sign of that capitulation. And again, nobody puts a sign, nobody signposts when that was the bottom, on that day. Now it's safe to get back in. But as we look back on this chart, there is a pretty profound selling in those 8 days between June 8th and June 16th. And I think a strong argument could be made that was a lot of capitulation. The most dangerous markets are absolutely stuff that we are steering clear of. Developed and emerging markets, both inflation, issues, as well as their own central banks. If they have a central bank, becomes a problem for us. In the emerging markets, they don't have central banks usually, and we don't want to participate anywhere where a strong dollar is going to impact their ability to repay, any sort of debt. And I just don't think that we're going to see in the wake of such rampant inflation. Great areas coming either out of small cap emerging markets or even developed markets right now. So we're sticking pretty close to U.S. markets. These areas continue to see technical breakdowns. So we're not saying that the bottom isn't on the entirety of the market. We think other parts of the world are going to be negatively impacted by fundamental weakness going forward. And so we're strictly kind of talking about the US here. Some of the things that we think, a lot of the sectors we start thinking are registering oversold territories. We expect that's going to be confirmed by some better than expected earnings coming up from some of the technology names, healthcare names, and even banks saying, hey, things are pretty healthy. Revenue is still in line. And even though they've handicapped their own exposure to rising interest rates and inflation, that these are still areas that are inflation resistant. Think back to the article that we had written and sent out to you a couple of weeks ago saying, hey, we're looking for companies that can raise their revenue lines along with inflation so that turns into growth when the inflation numbers subside. I think we're in the early stages of a trough, which means that there's going to be some short-term volatility, both up and down, some quick bear market rallies that cause us to have these bouts of pain and bouts of second questioning, but it's going to ultimately lead into a repetitive uptrend. So we think the downtrend is still intact, as you can see on that chart. We haven't really broken out of what is that trend, but I think this, if you keep an eye on this recent drift up, there's a pair of key levels that I think are going to stay intact, and we're going to keep our eyes on those. So the other thing we want to look at is ultimately volatility, and we're looking for other indicators that show that at least the worst is behind us. For us, we're looking at the VIX here. Our gauge that measures volatility for the S&P 500 has been mostly muted. The VIX is essentially a financial product that demonstrates the cost of insurance for insuring the S&P 500 or downside on the S&P 500. So when markets sell off, the price of that insurance spikes. In the last couple of months, and in the last 30 days, the cost of that insurance is down by 18.5%. And so while we don't know if the market is in, we're saying that the depth by which the market can fall has clearly been muted because people aren't insuring it at such a rate that they were before. The market is not paying up for those premiums to insure against that downside. This is usually a pretty positive indicator, and more importantly, the volatility of the VIX of the VIX, the amount that number is shifting, is also pretty muted. So that says that there's a pretty good equilibrium between buyers and sellers right here. This is a good place to start saying, hey, can we expect a turnaround? We're seeing that range-bound battle for some time now, but I think it's been at least 3 weeks now. We've seen the volatility of that volatility really start to contract, start to be really, really tight. So neither side is really reacting in extreme ways. That's a pretty good indicator that everybody has found their price discovery, that they're comfortable with what they own. There isn't rampant selling and there isn't rampant buying, and that allows us to be more constructive from there. Then good news becomes good news again, and we stop just selling all things together. Finding that middle point between buyers and sellers, which is what the market is trying to do on a daily basis when there isn't huge swings, means that buyers and sellers are kind of in agreement that this is a good equilibrium point. So those major swings should be a thing of the past, and pricing here, should be a little bit more contracted and hopefully more constructive. So what is it that we are doing at InSight to kind of read and react to these conditions? I think there's 3 things we can do. We can look backwards and we can react to things that have happened to the portfolios. We can look at what's happening in the market right now and make some changes, and we're going to look forwards. We're covering all 3 of these. We are looking backwards for tax loss harvesting opportunities. We are buying into good sectors in the market that have good cash flow in the now, and we're becoming more tactical going forward. We want to make the most out of being in this very trophy part down at the bottom. The first direction that we look is backwards. What happened to the portfolios and how can we make the most of them? Without losing a couple of things. We don't want to lose our expectation of certain dividends and incomes and interest, and we don't want to lose our exposure to the market in case there is a turnaround. And so for that, and we've talked about this before, we've done a lot of it already going into this. We've done some tax loss harvesting. We've, Peter and I have recounted accounts. We've gone through and said, where can we actually start embedding some of these losses into their portfolio, so that we can have good long-term, management, bringing down taxation in portfolios and ultimately creating more wealth that way. So inside all the accounts where there have been substantial tax losses that we could take out, we've done pretty well of realizing those losses, so that as we see gains in the coming months and years and decades, we can continue to tap into those loss reserves that we've established in your accounts. These can also be used in other places if you have real estate gains, personal property, or have done something outside of what we help you manage with. These are boons that we've been able to extract from the market just being down without having to leave the position or permanently impair the portfolio by going strictly to cash. So these efforts are mostly in the rearview mirror. We hope that if we have seen this downslide, that we've put all of those losses embedded into your account, and we can now use those and extrapolate those as you need going forward. So that's what we kind of do in the rearview mirror. What are we doing right now? The second thing that we look forward to is buying more current cash flow. We are still very much interested in buying companies for clients that have good free cash flow. It's still very high. This is a leading indicator to a company's long-term health and its ability to survive a recession. With these assets intact and with their cash flows intact, companies are still making money. Several of these companies have done a fantastic job of shoring up their balance sheets in a way to help them withstand any decline in revenues if they see it, or compression in margins, without being detrimental to their outlook. These are companies that are getting ready for battle with a recession, for battle with each other. They have very healthy margins, balance sheets, and they're still making money regardless of what the pricing in the marketplace is doing for them. So on the whole, while the whole of the market is selling off, there are several different sectors and companies that have been in anticipation of this, have very tight balance sheets, still make those money. Several of those names can be found in healthcare spaces, technology, particularly in the enterprise software. So big enterprise software companies that you've heard of have very robust balance sheets. This includes Microsoft and Oracle, CRM, Salesforce, and in banking. Banking has kind of been the dog since the last recession, but banks actually look very healthy. Their lending standards are largely intact. They've been able to make money in a plethora of different ways. And as we see rates continue to rise for them, it's going to actually do better things for banking in the long run. So these companies can create new revenue right now, even in the wake of an economic, or in the anticipation of an economic slowdown, and will be the ones to be able to throw their weight around in the months and years to come as we head into what could be contraction. It might be considered a recession. They can easily return money to shareholders. They do it in a couple different ways, either through buybacks or dividends. They can acquire some of their less solvent competitors. And generally they can press their advantage and gain market share when things like pricing becomes really important. So if there are two competitors and one can, push the other one to the brink, if they're selling a similar product, they're going to be more competitive in a tight situation if they have good free cash flow on their balance sheet. That's how we know. So we're absolutely trying to prepare portfolios and buy companies that do that, so that in the wake of an economic slowdown, these are the ones that are throwing their weight around and becoming very successful companies. And those companies are all showing their cards right now. They're doing that by having tight, healthy balance sheets that show lots of good and growing free cash flow. The third thing that we can do to help everything, help our portfolios and do well by our clients, is to get more tactical. The bear market has, instead of a steady precipitous incline that we see in bull markets, bear markets have these moments of huge price swings and huge elevators in price changes. It's a reactionary, it's very driven by greed and fear at the same time. And it's a lack of understanding of economic and fundamental direction. So it's just the market being the market. And so what we want to do is recognize that there are times where momentum is a leading indicator to those very quick upshots in pricing. They're very abrupt on both directions. They don't generally mean the portfolio is, on the whole, 10% up one direction, 10% down in another direction, but they give us these narrow windows of 2 to 4% that we can start capturing some of the upside. So what we've been doing, at least for the last 7 weeks, is we've been using an ETF product called SSO or SPUU in some of the alternative portfolios through the tax loss harvesting stuff to try to capture some of those swings. This ETF allows us to move twice the distance of the S&P 500 on any given day in any given direction. So if the market is up 1%, this portfolio or that part of your portfolio should be up 2. We were able to buy these. So if you look at this chart here, we were able to buy these on those green arrows and sell them on the white arrows. So we've been very efficient at timing through momentum indicators when we wanted to be in this levered position. And what this is going to do for us, or ideally what this is going to do for us, is able to raise cash through these times. So even though the market might be trading flat or boring, we're using these small volatile swings to try to add more cash and buying power into the portfolio. And if we can continue to do it with the same accuracy we've demonstrated over the last 7 weeks, we can effectively capture some additional revenue, some additional buying power here while we are at the bottom, or at least making these bottoming motions. We'll continue to do that as long as the market gives us the capacity to do so. And then ideally, we will be in those kind of levered positions for the first and earliest returns to normality in the market. When the first couple of innings are in and this is a bottom and we see some of the best growth in capital, maybe best return to higher prices in the S&P 500, we'll kind of get double that motion. And then we'll return to just having our normal portfolio that has the normal exposure. So in these areas, it allows us to capture a little bit more upside. And because we've managed it so efficiently, and we've got, you can look at the chart here, we've done a pretty good job of being able to kind of soften the blow and soften being down here, make the most of being down here. So that's kind of like the direction that, where we've been and what we look at for right now. We understand that being in markets is frustrating sometimes. It's not as simple as buy low, sell high. There's a lot of nuance in what we do, but just knowing that there's at least 3 things that we can be providing to clients right now, some of which is already kind of put in that back pocket through the tax loss harvesting. That not every company out there is in dire straits. There are still very healthy indicators. This market is still at 3.6% unemployment. So what the recession might look like is simply a contraction in some of the GDP numbers we see, but not necessarily people out of work and destitute. And so it's not going to be a violent recession. And finally, that there are swings that we can do right now that allow us to be more tactical in this position and make the most of just being down here, so that when we return to normal pricing, we return to a growing economy, that we have the companies and we have the right portfolio for going into that next middle innings of the next recovery, of the next climb in this market. My name is Kevin Taylor, and as always, give Peter or I a call. We are happy to walk you through your portfolio and explain what we own and why we own it, or how this portfolio is helping you keep that trajectory and maintain your performance and keep your insightful plan intact. Thank you very much. This has been Nearsight and Farsight, and I'm Kevin Taylor.